And if you have any questions along the way, just throw them in the chat and I'll get them kind of as we go. So this is going to be basically some loan basics every real estate agent needs to know. This is to help you write your offers correctly in the beginning and also have conversation points with, when you're out in public and you're talking to your friends and family or the person standing in front of you in the grocery line. Um, to be able to kind of vet out if this person actually could qualify for financing when in fact maybe they think they cannot. So that's really, one of the main reasons why I wanted to do this. We do get questions a lot on FHA and things like that. So we're going to cover some FHA and then again, just some loan basics that'll just kind of help you with everyday conversation and also with your offers. So um, this is kind of a big one. Loan limits on closing cost credit per loan type. Um, I've displayed this one previously. It's a good reminder. So there are limits to the amount of credit your client can have as far as if you're contributing some of your commission or if the seller's contributing any amount of, you know, closing cost credit, maybe initially in the offer, and then you go and negotiate some repair request, and it turns out to be a credit as well that you're all kind of stacking together now. Well, sometimes that amount goes over what they can actually accept. So we need to be very careful of that. Um, so Fannie, Freddie, and the FHA specify limits on how much a seller or broker can contribute to the buyer to pay for services typically paid for by the buyer. So for conventional financing, so if you have um, uh, a client who wants to use conventional financing, the amount of seller credit or just credit in general that they can receive is actually based on the loan amount and how much they're putting down. So if the down payment is less than 10%, the maximum credit is usually limited to 3% of the purchase price. If the down payment is between 10 and 25%, the limit may increase to 6% of the purchase price. And buyers with a down payment of 25% or higher may receive credits up to 9% of the purchase price. Actually, never really seen them that high, but I guess it could happen. Um, if the home is an investment property, the credit's going to be limited to 2% regardless of how much money they're putting down. So if this is something they're going to rent out, um, just know that they can't go above that 2%. For FHA financing, the limits are 6% of the purchase price, regardless of the down payment size. It's just 6% is what they can accept across the board. VA, same thing, doesn't matter about the purchase price. It's just a 4% across the board. And then if you happen to have anything in USDA territory, you're looking at also a 6% of the purchase price. I do have some links here for FHA, VA, and conforming loan limits. I can send this out to you if you want. Um, if you're curious, we can show it, but these do change usually once a year. There's some lenders out there right now that have already implemented the new 2026 amounts for conforming loan limits. They usually bump up a little bit every year. Um, for the most part, it's pretty fixed, but there are high cost areas especially in your coastal regions in California. A couple other states have some too, but California actually has the most high cost areas. So you're looking at your Bay Area, you're looking at, coastal OC and LA and San Diego primarily. So QM and non-QM loans, you may hear QM and non-QM get thrown around a little bit, and maybe you just don't know what it is. So let's just go over the differences of what QM and non-QM loans are. So a qualified mortgage, that's the QM, is a type of loan um, that meets specific federal rules designed to make sure borrowers can reasonably repay their mortgage. A qualified mortgage is the standard, safe type of loan most home buyers use It means the lender fully checks income and ability to repay. The monthly payment is predictable and there aren't any hidden tricks. But if your buyer is FHA, or conventional, they're almost always using a QM loan. And this ability to repay rule is a big one in the mortgage industry. That's um, that's why sometimes the underwriting guidelines do get so strict as things go on. Maybe documentation that your client has sent in raises concerns about their ability to repay, and then maybe gets conditioned a little bit more. So that's why sometimes you have loans going in and out of underwriting, maybe a couple times and, potentially causing a delay. It's because more than likely, especially on a QM loan, they're verifying the rule of ability to repay. Key feature of a QM loan, full documentation, borrower must prove income, employment, and assets with pay stubs, W-2s, tax returns, and bank statements. Safe loan structure, so no risky loan features like negative amortization, interest only, or balloon payments. Ability to repay rule, lenders must verify that the borrower can actually afford the loan. Debt to income limit, that's DTI. If you hear DTI getting thrown around, it's debt to income limit, is generally capped at 43%, though FHA, VA, and some conforming conventionals have exceptions. FHA, you can get into the 56s on the DTI. So that's why some do go with FHA versus like that 3% conventional loan, because they have a higher debt to income ratio on that. Points and fees cap, lender fees are capped at 3% of the loan amount for most loans. What QM loans don't allow: no teaser loans that hide big payment jumps, no interest-only loans, no negative amortization. That's where the loan grows balance instead of shrinks. And no balloon payments, which is going to be a giant lump sum of money due at the end. Common examples of QM loans: conventional loans, just your standard conventional loan. FHA, VA, USDA loans, most fixed rate mortgages, and standard ARMs. So what is a non-QM loan? Personally, I prefer these as a loan originator. It's usually a lot of business owners and things like that, so I kind of speak their language. So they're my preferred loan type, but here's what you're looking at, a non-QM loan. So that is a non-qualified mortgage. So non-QM is a type of home loan that does not meet the federal qualified mortgage QM rules. Non-QM loans are for buyers who can afford a mortgage but don't fit in the normal rules. Think of self-employed business owners, investors, or high asset clients whose paperwork doesn't line up with standard guidelines. These loans give them options, though they often come with higher rates. How much higher? Depends on the loan type. Your standard kind of bank statement product really isn't going to be a whole lot higher than what a conforming conventional might be, but there is a little bit of a rate bump. Key features of non-QM loans: flexible documentation. Instead of tax returns or W-2s, lenders may use bank statements, rental income, which would be for a DSCR loan, which we'll cover here in a few minutes, or assets to verify income. Higher DTI, the debt to income, is allowed. Borrowers can sometimes qualify even if their debt to income ratio is above the 43%. I see 50% quite often on these. Specialty programs may allow interest-only payments, asset depletion loans, or ITIN loans. Investor-friendly, popular with real estate investors, especially the DSCR loans, which qualify based on rental income rather than personal income. What makes them different from QM loans? They don't always follow the ability to repay safe harbor standards. Generally they do, but not all loan types do. Often come with higher rates and fees to offset the risk that the investor is taking, and not backed by FHA, VA, USDA, Fannie Mae, or Freddie Mac. Common examples: bank statement loans qualify self-employed borrowers using 12 to 24 months of deposits instead of tax returns. The DSCR are investor loans. They qualify on the rental property cash flow and not the borrower's income. Asset depletion loans, high net worth clients qualify based on liquid assets instead of monthly income. When would you use that? Well, maybe someone's got 4 million bucks in the bank, but they are not employed. That would be a case for a asset depletion loan. I-10 loans, mortgages for borrowers with individual taxpayer identification numbers instead of social security numbers. So let me check the chat. I see a few. Okay. So we have one question from a page back. If the down payment is less than 20%, lenders still require PMI. If the property increases in value, are they dropping the PMI at some point? Usually that's going to be triggering a refi in order to do that, so long as the value of the property is going to be there. And then yes on the PMI generally. All right, and this got a screenshot in there. So bank statement loans. These are some of my favorites actually, and this is what I use to purchase property as well. Bank statement loan is a type of non-QM that helps self-employed borrowers or business owners qualify for a mortgage. So if you have, somebody who owns their own business, maybe they're not paying themselves W-2, basically as an employee. They just have, their business account and money runs through there, and then, every month they transfer some money over into their account or whatever they're doing. That's going to be somebody who should be looking at the bank statement program. It's for self-employed borrowers. Instead of using tax returns, a lender looks at 12 or 24 months of bank statements to figure out income. It helps business owners qualify based on their actual cash flow, not just what shows on paper after write-offs. So what they're going to do is we're going to get, let's just say, 12 months of bank statements from the bank account and or accounts they want us to assess. I send that over to, we call it the lender, but that is the wholesale bank, and then they're going to do a calculation of all the deposits made into that, and they're going to determine which ones, if any or all, are based on the business. And then they're going to total those up, and then they are going to, they have ratios that they base the income off of based on those deposits. So a lot of times they'll get a pretty good pre-approval amount, especially if it's a business that's got a lot of cash deposits coming through, and your clients are pretty good about running everything through one account. That's a best case scenario for one of these. Key features of the bank statements are alternative income verification. So income is determined by averaging monthly deposits shown on the bank statements. Flexible options. Borrowers can use personal or business accounts. Some of our lending institutions will do a blend as well. And then they apply the expense factor for the business accounts. So they may say, okay, if you've got $150,000 in deposits that we're calculating for the year, we're going to cut that in half, and that's going to be essentially your yearly income broken up, obviously divided by the months as well. But so that's typically how they do that. Now, some of our banks will go higher than 50%. I've seen some go as high as a 75 on those deposits. It does depend on the type of business it is and if they have employees or not. Self-employed focus, popular with business owners, freelancers, and gig economy workers. whose tax returns don't reflect their true cash flow. Loan types available for primary, secondary, and investment properties. You can pretty much buy whatever with these. Why do bank statements, what do bank statement loans don't do? They don't require W-2s, they don't require pay stubs, and they don't require tax returns. They don't fit the QM standards, so they are a non-QM loan, and typically with higher rates and larger down payments than conventional loans. I can get all the way down to just a 10% down payment with these. So there's still, there's a lot of flexibility with these loans actually, and most business owners can qualify for these. So a quick example, borrower owns a landscaping company. Traditional tax returns show low income due to write-offs, but business checking shows $25,000 in deposits per month. The lender averages deposits over 12 months, which is going to equal 300K annual income, is used for the loan qualification. It's literally about that simple. DSCR, maybe you get this thrown around a lot and you don't know what it is. Well, these are also some pretty cool loans. And if you have investors who maybe they're getting a little tapped out, maybe they've been having to, they're going with a more conforming type loan, and now they're getting to a point where their DTI is just getting too high because the amount of properties they have financed. Well, you would want to talk to them about a DSCR loan. So this is for investors. So instead of looking at your job, the lender looks at the property's rental income. If rent covers the mortgage, the loan works. It's a faster way for investors to qualify for financing. This is literally the easiest loan for investors to get, so long as the property rents come in where they should. And if they don't, maybe they should, look at alternate properties that are netting a higher rent. So key features, property pays for itself. So the lender checks if the rental property income is enough to cover the monthly payment. It's literally that simple. The DSCR formula is rental income divided by mortgage payment, which includes the principal, interest, taxes, insurance, and HOA. So all expenses on the home. Example, rent is $2,000, payment is $1,600 all in. Then the DSCR is considered a 1.25% ratio, and it's good to go. You're actually going to get an improved interest rate with that as well. If it was even, then you're looking at, I don't want to say uh, a less favorable rate. How about that? So there's no job income verification, so the borrower doesn't need to show any W-2s or tax returns. It's investor focused, used only for rental properties, not primary residences. You cannot use this for primary. Faster approvals, simpler underwriting since it's property income based. So essentially, that's the documentation. The appraiser tacks on an addendum of, what the rents are going to be on that, or proposed rents on that particular property that they're buying. And they do that when they do the appraisal, and they submit it over to underwriting. And if these numbers look good here on the ratios, then they're essentially going to fund this property. So it is literally that easy. What DSCR loans don't do, they don't look at the borrower's personal debt to income. That doesn't matter whatsoever. They're not for owner-occupied properties and usually come with higher rates and down payments than conventional loans. You're going to be looking at 20% on the minimum on these. There's a few others out there that say they can go down to 15 or 10. There's a little bit of a caveat with those. Basically plan on 20% being the minimum to get into one of these at a decent interest rate. Common uses for these: buying a single family rental property, financing small multifamily, duplex, triplex, fourplex, short-term rentals. If you have people looking to get into short-term rentals, this is a great loan for that. If rental outcome is documented. So if they're buying one with a book of business already. So any questions on the DSCRs? One is, do lenders prefer W-2 over bank statements? Is it because it's easier process? Um, I guess it really depends on the lender, because a lot of them just specialize in certain things. They'll have a variety of product, but some of them really have a focus on certain products like the bank statement or like the non-QM realm of lending. Other ones are they don't. Some of the lenders that we deal with, they don't even do non-QM. They only do traditional conforming, and so they might have the better rates with the FHAs and things like that. It's not so much preference, I guess, of overall. It's what that particular loan officer kind of specializes in, or what they like to do. Interest rate on the DSCR, on refinance investment properties. DSCR is probably running in the mid eights right now, maybe a little less. Again, it's a simple way to get into for an investor to get into the property. They don't have a limit on how many of these you can use or anything, but the rates are a little higher. If you're talking bank statement program, or even asset depletion or something like that, you're looking usually about a half point higher than a conforming conventional, what you might see out there. So sometimes a little better than that. Depends on credit score. They do weigh on credit score quite heavy. Asset depletion loan. This one is interesting. So, an asset depletion loan, sometimes called the asset-based loan, is a type of non-QM loan where a borrower qualifies for a mortgage using their assets instead of income. An asset depletion loan is for clients who may not have a regular paycheck but have strong assets, like retirees or investors. The lender takes their savings or investments, spreads it out over time, and counts that as income to help them qualify for the mortgage. So if you have somebody like this who thinks maybe they can't obtain a loan because they don't have any income right now, or maybe they're, on Social Security, or they have a very small income coming in, but they've got a bunch of money in the bank, then we want to look at one of these to be able to qualify them. Key features: income is from the assets, not from a job. So instead of using W-2 or pay stubs or tax returns, the lender calculates monthly income by dividing total assets over a period, often 120 or 360 months. Eligible assets: cash in a checking or savings account, stocks, bonds, mutual funds, retirement accounts, sometimes discounted if not yet at retirement age. No traditional employment verification. So this works well for retirees and high net worth individuals or self-employed borrowers with large reserves. Property types: usually available for primary homes, secondary homes, and sometimes investment properties. Um, so this is an interesting loan product. So again, if you have clients like this, I've just, kind of given up because they don't think they can qualify. This is a pretty great loan. It's not hard to do, and the rates really aren't that much, worse than your standard conforming conventional. You'll be looking more like a bank statement rate, so maybe about a half point bump or something like that. What asset depletion loans don't do? They don't require steady job income. They don't use standard debt to income ratios based on salary. They do require substantial liquid or near liquid assets. It's not an option for buyers without reserves. So, quick example: borrower has 1.2 million in liquid assets. Lender uses 120 month, which is a 10-year factor. So you're going to take 1.2 million divided by 120 equals 10K a month in, income in quotes. The loan is underwritten as if the borrower earns 10,000 per month, even without employment income. So it's literally about that easy. All right. Any yes, credit score is looked at on all of these loans, Manny. That is a factor. So let's get into, I wish my thing wasn't off here, but let's look at market share essentially of these different types of loans and what areas of California have this predominantly. Now, I only pulled like major metros. I didn't get into cities and things like that. It's too much data. So this is FHA share of mortgaged homes purchases by major metro. So you can see we've got the Inland Empire. They're coming in at about 26.7% are using FHA financing on their home purchase. Um, then you have higher cost areas like San Diego, Orange County. Um, these are at a much lower rate. Orange County, especially, there's really not much FHA going on whatsoever. Sacramento, looking at about 13.7. Los Angeles County, about 14.3. And you're probably sitting back thinking, why is LA, um, higher than Orange County and San Diego? Well, LA is a big county, and there is some quite a few areas that are more kind of priced like that Inland Empire. And so that brings that percentage up a little bit of borrowers that prefer to use FHA. And Fresno County, coming at the highest at 29.1, are using FHA financing. VA share of mortgaged homes purchases by major metro. So we've got Riverside and San Bernardino, the Inland Empire, coming in much lower actually at 8.3. But now San Diego, you're looking at 14.4. So why is because there are military bases in San Diego. And so there is quite a bit of VA financing that happens. Orange County, Sacramento, Los Angeles, you can see all of them are right about that 8.3 or less. Same with Fresno County. So essentially, if you live in a county or city or region that has a fair amount of bases, large bases, military bases, then more than likely you're going to have more borrowers using VA financing. So, if that's a target area for you, you want to, work with those types of clients, then it's looking like San Diego is a place where you want to be. Um, Next up, we got conventional share of mortgaged home purchases. So this is the largest. Most people use conventional type more financing. Inland Empire, we're looking at 65%. San Diego 75, Orange County a whopping 92%. Sacramento 80, LA 81, and Fresno 62 and a half, because you can remember that a lot of it was FHA. So by far the most popular product out there is the conventional loan. Non-QM share of mortgage home purchases by major metro. So this is combining all those same areas, and who's using the non-QM stuff? Well, in 2024, the average is about 5%. But as of July of 2025, it has bumped up to 8% using non-QM type products. I have seen the DSCR loan really kind of take off for investors. They really seem to like that product. It's been talked about a lot more often. So that could be part of it. I don't have a breakdown of that, of what types of non-QM, but it could be that there's just more self-employed people out there, gig workers, things like that, that are choosing to use that type of product because, that is their secondary income or that's their sole income. So non-QM market trend. So non-QM, 5% 2024. California and Florida together account for about 40% of non-QM originations, which is pretty huge actually. Non-QM includes the bank statement, DSCR, asset completion, ITIN, expanded DTI, all the stuff that we already talked about. Breaking down the data. So translating the known FHA-VA mix from the charts above into practical non-QM positioning for each market. So rule of thumb, the higher the prices and the more self-employed investor activity, the more non-QM shows up, especially bank statement and DSCR. And that's what I actually see the most of, are those two types of loans right there. So Riverside, San Bernardino, FHA is 27, VA 8. That leaves a majority conventional, but non-QM demand shows up for investors buying single families, and especially if they want to add in the ADU, and self-employed trades, contractors, logistics, warehousing spillover, bank statement programs. What to do with this data? Screen for investors and self-employed who miss agency ratios. So agency is going to be the QM loans. So if you have someone that's just, their debt to income is too high, then maybe they want to look at some non-QM product. Compare the DSCR versus conventional when the DTI doesn't pencil out, and show the cash flow math. San Diego, VA is high, 14%. Conventional still dominates. Where non-QM appears, higher price points, and jumbo adjacent buyers who don't fit agency guidelines, and short-term rental investors. So again, the DSCR angle for the agents, for self-employed coastal buyers who strong cash but tricky docs. And we do see that, where how they prove their income is tough. There's multiple streams coming in and multiple accounts and stuff like that. So we want to be looking at the bank statement versus the jumbo pathways for short-term rentals, DSCR with realistic occupancy assumptions. Orange County, extremely conventional. We saw that 92%. Non-QM is niche, but valuable at the jumbo edge. So the jumbo is loans that are above the conforming balances. For entrepreneurs and high asset clients whose documentation doesn't match income reality. Agent angle, present asset depletion and bank statement options early, align sellers on certainty of funds and pre-underwriting to complete with all cash. Some of these people are some of the strongest buyers out there. We always say cash is king, and that is very true. But when dealing with the asset depletion loans or bank statement products, those are typically some of the strongest buyers out there. So if you do see, if you're on the listing side and you have someone using one of these types of loans, that's where proof of funds comes in. Double check on that stuff, but you'll find that usually these people have substantial amounts of money, or a lot of deposits coming in. They're strong borrowers. Sacramento, mixed market, FHA 14, VA 6, the rest is conventional. Non-QM shows up for small portfolio investors, duplex and quads or ADU plays, and self-employed Bay Area migrants who telecommute but don't fit agency ratios. The angle for agents, when DTI or documentation disqualifies, price the bank statement versus conventional and show the DSCR with the ADU add-ons. Los Angeles, county skew is 82% conventional, 14 FHA, 4 VA, very low in the VA. Non-QM pockets, luxury, creative income borrowers, gig entertainment industry, and investor rehabs. See a lot of investor rehabs in that area. Agent angle, bring asset depletion and bank statement lenders into deals early for flips or mid-rehab purchases. Explore DSCR if the rent is stabilized, or bridge to non-QM paths. So again, this isn't stuff that you have to remember so much, but this, I want you to be able to know that these products are here and how to talk to the borrowers and then get them over to the lender, but at least you'll know that, hey, there's a really good chance that this person actually could qualify for a mortgage. So I want to get them over to the lender to talk about it a little bit more. Fresno County, FHA 29, VA 8, conventional 63. Non-QM uses small cases, small town investors, doing DSCR at lower price points, self-employed, ag contractor borrowers needing bank statements to qualify. Agent angle for those in Fresno, lead with payment DSCR coverage instead of DTI. Compare bank statement 12, 24 month versus full doc, conventional to keep deals alive. I guess, side note here, you keep seeing bank statement 12 and 24 month. So they typically have two different products. They have a 12-month bank statement program and a 24-month bank statement program. And typically the 24-month has a slightly better interest rate on it because you're proving deposits for a longer period of time. But if the business is a little newer or maybe um, was kind of struggling a little bit for the first 12 months of ownership, or past 12 months, and maybe it was a little rough, but now they're doing much better in the current 12 months. Maybe we want to look at the current 12 months versus the whole 24-month period. So we'll jump into FHA financing and what agents need to know about it for your offers, whether you're on the listing side or the buy side. Let's look at some things to look at here. So, is an inspection necessary on all FHA transactions? I do hear that, like, oh, we have to get the termite, we have to get the clearance, and it's not true, actually. Neither are required, either a termite clearance or a home inspection. The FHA inspection notice simply provides a disclosure to the purchaser that FHA does not warrant the value or condition of the property. An appraisal is not a home inspection. And those do get confused because, industry terms will say the appraisal inspection. And if you've done FHA before, you know that the appraiser sometimes conditions things on that appraisal to have corrected before basically that appraisal is certified. So, but that is not the home inspection, and that is not the inspection that we're referring to. The borrower has the right to have the house inspected by a professional home inspector. Whether or not to inspect the property is a matter of contract between seller and buyer. The residential purchase agreement permits a buyer to obtain a property inspection with an agreed upon period of time. Obviously, an inspection should always be advised. Use forms BIA, HID, and BIE to help advise this. That is why we put the BIE, the Buyer Inspection Advisory, on the list. It's great to have. It's basically showing the client what types of inspections are out there, because a lot of them have no idea all the different types of inspections that are out there and available for them to get on their home. And that could be based on region and condition of the home and different things like that. But that's a great little document to use. All I do is kind of check off the stuff that they're planning to get. When is the FHA inspection notice required? So that's Form HID. They package this in with the FVAC form, which you also have to fill out on a FHA or VA purchase. So the FHA inspection notice must be signed and dated by the borrowers on or before the date the sales contract is executed. So you want to add this in with your offer in the beginning. Don't add it in later. This needs to be done in the beginning. Or re-executed if necessary for all transactions that will involve FHA mortgage insurance on existing property. For FHA loans secured by existing properties, the inspection notice must be dated and have the borrower's signature. New construction is exempt since the house was recently inspected during construction. Refinance transactions are exempt. So the FVAC and HID should be included with your initial offer. May the inspection be financed as part of the FHA mortgage? And actually, yes, up to $300 of the cost of an inspection may be financed into the FHA mortgage. So for your borrowers or your clients who a little shy on cash because they're buying a house and it's expensive, this is a cost that they could actually finance in. FHA will not approve condominium projects with the following characteristics. Co-ops, which are not real popular in California. Condominium hotel or condotel. Again, you don't see those too often either. Mandatory rental pooling agreements that require unit owners to either rent their units or give a management firm control over the occupancy of the units. Timeshare or segmented ownership projects, multi-dwelling condominiums, so more than one dwelling per condominium unit. So it'd be like a condo that has 2 units within the condo. Houseboat project, continuing care facility, coastal barrier resources system location, subject to adverse determination for significant issues as identified by FHA. So condos are tough with FHA, FHA and VA, but primarily FHA. Really talk to your lender first before you start working with a client that's looking for a condo using FHA financing because FHA seems to not like condos very much. So the acceptable level of owner occupancy percentage is at least 50% of the number of units. So if it is a community, a condo community that has just the majority of them leased out, then it's probably not going to qualify for FHA. FHA appraisal requirements, this is always a big question. So there are 2 parts to an FHA appraisal, the market research and then the inspection. And again, this is not the home inspection, we're talking about the appraisal inspection. The lender reviews both sections to make sure the home's value is high enough to approve your mortgage and that it meets all the FHA guidelines for safety and livability. Market research portion of the FHA appraisal. In the market research, an appraiser determines the stability of home prices in the area. They must cite several things, including 2 comparable sales closed within 90 days of the appraisal, 3 recently closed sales within the property subdivision, 2 active listings or pending sales. So this is good information if you are a listing agent and want to open this, you're listing up to FHA buyers, if you're looking at the comparables, will you be able to, will this property be able to fall in with these guidelines as well as the livability portion of it? So we have a few questions here. Yes, there are spot approvals for FHA. Usually it's going to be fine. We did run into one recently. It was actually not FHA, but still same guidelines where the community has not fully complied with the new balcony law. They've only repaired part of the units, and so it does not qualify. The unit itself was fixed, but the community as a whole has not been fully updated with the new balcony law. So it is, we cannot get financing on that one. So, and then question, can we do FHA spot approvals on condos? Yes, we can do spot approvals. General FHA appraisal checklist. In the inspection, FHA appraiser will search for things that affect the health and safety of the occupants. These things also contribute to the remaining life and marketability of the home. So they're going to look at the physical structure of the building, no damage to the home's exterior, foundation, and roof, no sign of insect infestation, no loose wiring or exposed electrical systems, adequate ventilation of attics and crawl spaces, the livability of the building, working utilities including electricity, heat, and clean water, safe and sanitary sewage disposal, no lead paint, all fire codes and applicable safety codes are met. They're going to look at the property site, no soil contaminants or underground storage tanks, topography drains water away from the building, and safe and reasonable property access. I'm going to click this. This wasn't working yesterday, but okay. So I do have a sample of the property inspection report that the appraiser needs to submit along with their appraisal. So if you want a copy of this, we'll put this document that I'm using um, in the remarks and the recording um, of this webinar. Let's see here. I had one other one. I'm hoping the link works on it too. It's kind of weird because the HUD site doesn't work on the weekends, only during business hours. So this is what an appraiser is looking for at the time of the appraisal inspection per HUD.gov. Let's see if I can get this one to open. It looks like it is. I'm gonna have to research that one again. I'll see about getting that one fixed. They moved it. So a couple of quick things and we can wrap up right about on time. Let me scroll through here. Sorry about that. Okay, so practice it. In a transaction involving FHA or VA loan, repair of habitability conditions by seller may be a buyer's lender requirement. In this situation, it's best to get a commitment from the seller that they will make any such repairs up front, although most will not agree in a seller's market. This can be added in G2 of the RPA. So we're basically just my arrow here didn't go all the way up to the top, but in E1 right here, you have if FHA or VA is checked, which I checkboxed the FHA, deliver a list of lender required repairs. You can see by default is within 17 days. So on the next page, if on your contingency release timelines, if you are modifying those to be shorter, your investigations period and whatnot, probably you're going to want to do this to match. My thing is off right here. G2 is where you could type in, if you wanted to, some sort of obligation that the seller agrees to remedy any requirements from the appraisal uh, and make it to the cost of the seller, not to the buyer. So sorry, my thing got off here. So you can try and get the seller to agree up front. If I was a listing agent, that's probably not going to happen. But it all depends on the seller scenario as well. Sometimes they just want to get a good offer. They're cool with making some repairs. They want to move on. So if that's where your seller is at, then just make sure that you're explaining this well to them, that if they are agreeing up front, we don't know what that amount is yet. Could be $100, could be 5,000, depending on what's going on with the house. So really, as a real estate agent, you want to take kind of a walk around, look for peeling paint and wood rot type stuff, because that's going to need to be corrected, and that stuff gets real expensive. Make sure there's heat. Make sure all the burners on the stove are working. Those are all habitability things that the appraiser is going to look for and check. So, and this is for both FHA and VA. And you're going to need to use the FVAC form. That should be submitted with your offer, which also has the HID. The HID is the for-year protection, get a home inspection form. It's a little one-pager. The FVAC also, yeah, it's a one-pager. Um, both agents also need to sign that one. So they must be added to the purchase agreement and signed by all parties as well as agents. If the final agreed upon price is different than the price in the original offer, then a new and final FVAC form will need to be signed and numbered as number 2 at the top. And this is what that FVAC form looks like. This is the mandatory clause. Basically, we're saying that my offer price should also match the price that you put in here. I threw 750 in there as an example. So if the final sales price ended up at 760, I need to do a new FVAC form. Basically, just get it done immediately. because that needs to go to the lender as well. The lender needs a copy of that before they can fund the loan. That's going to be one of their conditions. And then obviously we're going to need the new one for the file as well. Repairs. So if the sellers decline to agree to your additional provision from the example of G2 saying that we want you to agree up front to take care of any of these FHA issues that may arise. So if they don't agree to that, the buyer will need to make this request during the investigations period as stated in 3E1 of the RPA, using CAR Form RR, which is the request for repairs. The default timeline, as we saw in the RPAs, for 17 days. Essentially, there is, if you look at the request for repairs form, they have a FHA VA part in here, and it says the lender requires specified actions in the appraisal or other lender documentation if checked, which you can check box, and it says in section A here, buyer's FHA or VA lender requires the following items to be repaired. Buyer requests that the seller repair the following items, and seller or checkbox buyer shall pay for any such repair. So it's defaulted to the seller to pay. Again, this is a request. If they did not agree up front that they were going to take care of these, then they don't have an obligation to. Even though they took that FHA offer, this is still a request. And especially if this amount comes back really high, then your deal is going to be probably in jeopardy if you can't get this negotiated out. So that's why if you can get them to agree up front to take care of any items noted by the appraisal inspection, obviously that's going to be your easiest path to keep moving forward because you'll make your repairs and say, hey, you already agreed. I mean, you'll make your repair request, say, hey, you already agreed, and hopefully things will continue moving on. So, yeah, the reminder is this is still a buyer's request, just like any other thing that you're going to be requesting of them. It is not a seller obligation if not agreed to upfront in the original offer or counter offers, and a seller can deny this request. Also, if it is a condition of the appraisal where they said you need to secure the loose toilet and paint the eaves, a credit cannot be negotiated for this. Those items have to be repaired. And then what's going to happen is they're going to have a second inspection come out to verify that those items were done. The appraiser signs off on it, goes back to the lender, and then you know, finishes up underwriting, and hopefully you get to the documents. So that's all I got for you today. Hopefully you learned a little bit about loans. You don't have to know all the nitty-gritty with loans, but just knowing what products are out there and some very, very basics of it could really open up, could unlock some extra deals for you, because you might be talking to people who really are motivated to buy a house and think that they cannot get a loan right now. So that's why it's good to be, I say a little dangerous with your knowledge on loans, loan product. We don't want to be out there quoting rates and doing all this kind of stuff. But can you say, hey, this sounds like you could purchase a house based on this type of loan or that type of loan, and open up the conversation, get them over to the lender, and hopefully you'll get a deal out of it. So I think we had one over in the Q&A. All right. No problem, Lorenzo. Thanks for attending. And that's all I got for you today. If you have any questions, always give us a call. We're around. And hopefully you learned a little bit today, and make it a great week. We'll talk to you soon.